What's up, guys? It's Jared Allison. So the economy has had a really busy year this year. The Feds have raised the interest rates again by 25 basis points. The S&P 500 is up almost 20% year to date. Inflation has consistently declined over the past 12 months. There might not actually be a recession after all, and home prices have not yet shown any declines. As always, there is a lot to cover, so let's jump into it, starting with the Feds. So on July 26th, the Feds raised the interest rates again, another 25 basis points to put us at an average range of 5.25% to 5.5%. What are these rate hikes actually doing for us? Well, the intention is to slow down the rate of inflation, and so far they have been successful. The hope is that inflation slows enough that the cost of goods will come back down, and then the Feds will lower the interest rates. And so far, that's been working. The consumer price index this time last year was showing an 8.5%, and currently it sits at just 3%. So even though the cost of goods are still rising, the rate at which they are rising has slowed down. So taking a look at the stock markets, the slowed inflation has actually had a positive effect on the stock market so far this year. Looking at the S&P 500, it is up almost 20% year to date. The Dow Jones is up almost 6%, which is the longest rally since 2017. And the Nasdaq is up a staggering 35% this year. So where are the markets headed from here? Well, it depends on who you ask. LPL Financial says while this latest rally may have outpaced fundamentals, the US economy and corporate America have remained resilient, though our base case still calls for a mild and short-lived recession to begin by the year end. Piper Sandler believes we will see a 20% plunge in the S&P 500, ending the year between 3,600 and 3,800. Now, Goldman Sachs, on the other hand, believes that we could end the year around 4,700. At the end of the day, it's really difficult to know exactly what's going to happen, and in my opinion, it's best to buy into the market for the long term, regardless of where anything is actually trading, because statistically, that leads to the highest returns. Now, what about housing this year? Well, we are still very low on inventory, and that is due to the fact that the majority of homeowners are locked into some of the lowest interest rates we have seen and are refusing to sell because, well, they don't want to give up that interest rate. Because of this, the National Association of Home Builders say that builders are feeling cautiously optimistic about market conditions given low levels of existing home inventory and ongoing gradual improvements for supply chains. And furthermore, a bottom is forming for single-family home building as builder sentiment continues to gradually rise from the beginning of the year. So what about existing homes? Well, let's take a look. On the national level, the NAR reports that the median existing home price for all housing types in June was $410,200, which is down only 0.9% from 2022. But despite the high cost, 33% of homes on the market had multiple offers, mainly due to the fact that inventory being down 14% from 1 year ago. What kind of people are buying homes? Well, first-time home buyers make up about 27% in June, and then all cash sales accounted for 26%, which 18% of these homes were purchased by investors. And here's another interesting fact. According to Redfin, only 14 out of every 1,000 homes were sold, which is the lowest turnover rate, at least in the last decade. They further say that mortgage rates would have to drop closer to 5% to free up some inventory, or we would have to see some increased home construction, zoning reforms, and tax incentives for buyers and sellers. Now let's look at a more local level, looking at the state of Florida, which reports a median home sales price of $420,000. That is no change from this time last year. Overall sales are down, and as a result, inventory is continuing to trend upward. Now remember to stay tuned to the end of this video where I'm going to show some more local county housing market stats. To sum it all up, are we actually going into a recession? Well, the expert opinions say no. The economy is actually doing quite well even with the higher interest rates. For example, the gross demand product continues to post marginal gains among other factors, and because of that, analysts are beginning to call this a rolling recession in which only some industries shrink while the overall economy remains above water. Others think that the US is experiencing what they call a recession, easy for you to say. Major job cuts, they note, have been concentrated in higher paying industries like technology and finance, heavy with professional workers who generally have the financial cushions to withstand layoffs. Job cuts in those fields as a result are less likely to sink the overall economy. Lastly, there are those that say that there will not be a recession at all because the economy doesn't face the types of dangerous imbalances or events like the stock market bubble in 2001 or the housing bubble in 2008. Going back to housing, should you buy or should you sell? Well, it's always been my opinion that if it's the right time for you, then do it. Most people come out on the losing end when they're trying to time the market highs and the lows, and it's just about the equivalent of flipping a coin. Yes, you could get lucky and guess it right, but in the long term, it really doesn't matter since the market generally comes out on top in the long run. Now, as promised, here are some of those local Central Florida housing market stats. Thank you so much for watching, and until next time, we'll see ya.